Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. Little bit of a different style of video today. Today I'm going to be watching a video from CNBC called How to Double Your Money in the Stock Market. I'm an investor in the stock market. I want to double my money in the stock market. Ideally, I want to double it multiple times over to kind of get a lot of compounding going. So very interested to see what CNBC have to say here, and it's a video that's been gathering quite a few views for the CNBC YouTube channel as well. So keen to see what CNBC have got to say. I'll add my thoughts to it as well, but for now let's get into it.
How long do you think it would take for you to double your money in the market?
9 years.
I like to teach new investors about compound rates of return by employing the rule of 72.
Okay, if you're a really early subscriber to my channel, you'll know that this has already got me hooked. Rule of 72 is a great, great mental hack for doing compounding in your head. And I'm pretty sure my first ever YouTube video was actually on the rule of 72. It's a terrible video, don't go watch it. But yeah, really good mental hack on how quickly or how long a time it takes to double your money. Rule of 72, learn that one.
Yearly rate of return, let's say 7%, and divide it into the number 72 to find out how many years it takes to double. So an investor receiving a 7% rate of return will see his or her money double in 10 years. At a 5% a year rate of return, an investor will wait 14 years to see their investment double.
I hope we don't only get 5%.
They'll wait just 8 years.
That's okay.
Doubling one's money throughout their life multiple times is the only chance most people have of getting rich. But it really is possible. Humans are comfortable thinking in terms of incrementalism. I eat a salad every day this week, I lose a few pounds. I do a set of push-ups each night, I get a little stronger. Not me, but like the proverbial person. But doubling is a little harder to conceive of, especially because of the
compounding is very hard to calculate in your head, so use the rule of 72. I'm guessing we're going to probably see some compound examples, and a lot of times these numbers blow people's minds. So definitely get your head around the rule of 72 if you can. Compounding, for whatever reason, just does not work well with the human brain. So that'll be a very useful hack for you.
Necessary in order to allow things to double. To see how hard it is for people to wrap their heads around the math of compounding, I hit the streets. Let's see what happened. I'm here with Jonathan. Jonathan, I want to ask you like very, very simple math question. Are you good at math?
I'm terrible.
So am I. What is 6 plus 6 plus 6?
18.
18? 6 times 3 is 18.
Really easy, right?
Yeah.
Your kindergartners could do it. Or
Well,
maybe
yeah.
not yet.
Getting there.
Okay.
Getting there.
All right. This gets a little harder.
Okay.
6 times 6 times 6.
Oh.
636 carried 3. 198. 196.
192.
They don't teach you those sort of times tables at school.
Very, very close. 260. Wow. Probably we won't use that part.
216?
Got it.
Wait, was that right?
Yes.
What?
You're the first person that got it right.
What? Really?
Yeah. Why do you think I'm asking you that?
I don't know.
Okay.
You tell me.
I'll tell you why. People have a lot of trouble thinking about compounding when they invest. How small numbers get very big over time. To think in terms of the exponential, right? It's so much easier to think linearly, but it's the most important concept in investing, and why you want to start now, as young as you guys are. Like, this is the best time. So,
made a video on this topic in the past before, cannot stress this enough. If you're in your 20s or if you're a teenager or any sort of early age group, you need to get into investing early. I'll leave a compound interest calculator in the description of this video. If you invest for 40 years rather than 30 years, so that extra sort of 10-year time frame, it's an extra third longer, but it's much more than a third of the actual dollars that you get at the end, just because of the nature of compounding. Those last few years, you get kind of the hockey stick curve and your money compounds through the roof in those last kind of final stages. So the earlier you can start, the far better off you're going to be when you get to retirement and want to start kind of eating into those savings and investments. So can't stress that enough.
if I asked you, what do you think the average annual return for the U.S. stock market has been since the end of World War II? Take
I'm
a
going to go
guess.
for 8%.
Well, ups and downs.
Actually, maybe slightly
Average,
higher
I
if
would
it's since
say
World War II.
5%?
Yeah.
6%.
6 or 7.
Let's go 8.
8 to 10.
Okay, she's very close. The actual number is 11.2%.
Ooh.
So what do you think that works out to over the 74-year period since the end of World War II? What's the total percent?
I would be a little bit cautious with 11.2%, as in I wouldn't use that for forecasting forward of what your results are going to be. That includes a period of massive inflation through the 80s. So the real returns are a lot lower than 11.2% after you account for inflation. And we experienced massive growth through that period with a whole bunch of changes in the economy. So when you hear the likes of people like Warren Buffett and Charlie Munger speak, you hear them talking in terms of more 6 to 7% long term rather than 11, but nonetheless the stock market's a great compounder of wealth. So just thought I'd chuck that one in there.
Guess a crazy number. You'll never get it. So 80%?
Yeah.
No. What about you? It's way bigger.
Crazy number. 200.
270,000%.
I would say I want to fact check that, but I also couldn't do 6 times 6 times 6.
You can trust me, I'm on TV.
Wow.
So is that an argument
That's
for
huge.
investing?
It totally is.
It is. The accumulation of wealth is quiet and steady for most investors, but nevertheless, it's extremely powerful. An investor with a 40-year time horizon, between say 25 and 65 years of age, could see their money double and double again many times over with a simple portfolio of stock and bond funds. And the best part is, they're always adding.
I'm pretty sure he just said stock and bond funds. At the moment, do not invest in a bond fund. Interest rates are so ridiculously low, you're not going to get, and this is not financial advice, but interest rates are so ridiculously low that you're not going to get any sort of reasonable return in a bond fund. If you want to keep some proportion of your money in fixed income investments, put it in a high interest savings account. It's so much more flexible. And if interest rates do rise, then you can maybe go ahead and buy some bonds if that's what you want to do. If you're very young, I'd say the stock market is always going to be the winner over the very long term. But if you're heading into retirement and are willing to sacrifice potentially some longer term gains for shorter term stability, maybe bonds are the way to go. But at the moment, bonds, in my opinion at least, just aren't an option. If you're getting 2 or 3% and then inflation is 2 or 3%, you're not going anywhere. So stock and bond funds over the extremely long term, yeah, sure. Right now, bond funds
so that new contributions may only be working on their first double, while older contributions may already be on their second or third go-round. Compounding while contributing is beautiful to watch in action.
Early money is much more powerful.
In slow motion.
It has longer.
Here's how Byron Reese makes the point in his book, The Fourth Age, talking about the creation of chess. About 1,000 years ago, a mathematician in what is today India is said to have brought his creation to the ruler and showed him how the game is played. The ruler, quite impressed, asked the mathematician what he wanted for a reward. The mathematician responded that he was a humble man, his needs were few. He simply asked that a single grain of rice would be placed on the first square of the chessboard, then 2 on the second, 4 on the third,
I've heard this one a few times.
each square doubling along the way. All he wanted was the rice that
this
would be
isn't
on
a good
the
argument for
square.
compound interest. I don't know what
How much rice do you think this is? Would it fill a silo? A warehouse? It is actually more rice than has ever been cultivated in the entire history of humanity.
Crazy. Just goes to show that if you invest for the long term and continue to make steady results or steady returns over time, it doesn't really actually matter what amount of money you start with, to be honest. You're going to end up with a lot of money even if you only start with $5,000 or $10,000. Assuming that you're continuing to put money in, you're going to do well long term. Don't get caught up in saying, I only have $1,000 or I only have $10,000 or whatever it is. If you can invest steadily over a long period of time, that early money is extremely powerful. If you're investing for, let's call it 40 years and you get multiple doubles throughout that investing time horizon, that first dollar you put in may actually be worth more like $30 in the future. So think of it like that. If you put in $1,000 now, that may be worth $32,000 way down the track if it doubles a few times. And if you put in $10,000, it may be worth $320,000 down the track. So the earlier you can put that money in, the better off you're going to be further down the track, and the more time it's going to have to grow and double and double and double. And as you've seen with this chessboard and rice example, even small amounts of money or small amounts of rice can get enormous very quick. I don't see you doubling your money 64 times within the chess example, because you'd have probably all of the wealth ever created, but really cool example nonetheless.
Vanity. Here's another example from Reese. Picture the Empire State Building.
Okay.
If I told you I was going to line up dominoes, and each domino gets 50% bigger, how many dominoes before you could knock over the Empire State Building?
320,000.
So it's so much less.
Like 1,000 dominoes?
200.
Okay, what do you got?
85.
75.
50.
Crazy.
It's 32 dominoes.
No.
No matter how much you work with compounding,
What?
your
Wow.
brain's just not going to get it. I'm
That's
afraid.
why you want to start investing now. So I think that speaks to the power of compounding. Little numbers.
This reminds me of actually the folding paper example. If you fold a piece of paper in half and then in half again and then in half again, there's limits on how much you can physically fold a piece of paper. I think it's like 8 or 9 times or something. But you have to fold a piece of paper in half a really, really small amount of times to get it to reach the moon, because of compounding and it doubling in height every time. It gets like ridiculously impossibly thin, obviously, as it gets higher and higher, and you keep folding it, and you couldn't physically do it most likely. But yeah, compounding is pretty incredible like that.
Really big, really, really fast, especially toward the end. Of course, there are risks. You could be doubling your money for decades only to see bad returns or lose money towards the end of your life when you really need it. But that's not a reason to sit out. Everyone's heard of Warren Buffett. Everyone knows he's rich, and he's pretty much always been rich. Not a lot of people are aware that almost 95% of all of the money he made after the age of 60. Warren Buffett was worth $3 or $4 billion in the late 1980s. He's since made an additional $80 billion. Warren Buffett has seen his net worth double 4.5 times in the last 30 years.
That's insane. Warren Buffett, I'm pretty sure Warren Buffett wasn't actually a millionaire until he was about 30. And he wasn't a billionaire till about 50. So goes to show, if you invest long term and continue to get steady results, you can turn any amount of money pretty much into a lot of money. I'm not saying you're going to be the next Warren Buffett, but yeah, pretty incredible.
Doubling your money 4.5 times sounds pretty good. It is not completely out of the realm of possibility for the average investor.
And there we have it. That was a really cool video from CNBC actually. A lot of what I see on CNBC is just talking heads and a lot of short-termism, but to see a video like that advising people to invest long-term and just track the market, take that type of steady long-term approach, is a nice change of pace, quite refreshing to see from CNBC. So pretty cool video. So that's all from today. Those are my thoughts on the CNBC how to double your money in the stock market video. If you enjoy these types of videos, definitely let me know. They're reasonably easy to film and that kind of stuff. So yeah, let me know if you enjoyed it. If you have any questions or anything like that, drop them down below. And if you enjoyed today's video, as always, be sure to hit like and subscribe. Really helps out the channel. And I will see you in the next video. Cheers.